What is going on, traders? Welcome back to the Traveling Trader, another top stocks video. These are the top 4 stocks to buy for April 2022. You guys seem to love these videos because they also give you an insight into the market. It's not just blind buying of ticker symbols. We are looking at market conditions and why we are looking at certain stocks based on what's going on. Obviously, this is all mid to long-term focused. These are not swing trades. Please don't try to swing trade off of videos. So first, I'll give you a brief market update, and then we'll get into the top 4 stocks to buy for April 2022. Everything will be time-stamped in the chapters below, so check there. And if you're wondering why there is a really ugly curtain behind me, I'm in Vegas right now, if you guys couldn't tell from the pattern. I've actually been invited to do a pretty big finance YouTube podcast. I'm not going to announce it here, but you will learn more about it in the future. And shout out to the drunk guy in the casino last night who managed to single me out of a crowd of hundreds. I mean, Vegas is packed right now, but it was good meeting you. And let's get right into it. Let's start with a brief market update based on what is happening right now during the month of April 2022, and then we will get into the top 4 stocks to buy. So, top things to watch right now, the inverted yield curve between the 10-year and the 2-year. This actually last week inverted twice briefly. This is when the 2-year treasury rates are actually higher than the 10-year ones. This happens because there's a lot of demand for longer term bonds to protect against inflation. So there's a lot of demand for the 10-year, not a lot of demand for the 2-year. And when nobody buys bonds, the rates keep going up to attract more investors. So the 2-year has actually inverted twice last week. However, if you watch my video here explaining all of this, we are also looking at the 10-year and the 3-month. To further contextualize yield curve inversions, the 2-year yield curve is a horrible way to predict timing. We know that a recession is likely to come within 7 to 24 months after the 10-year and 2-year inverts. However, it is a horrible predictor of time, and the market usually rips. Obviously, you have half a year to 2 years until a recession hits on average. What happens in between then usually is the market rips because there is literally nowhere else to put your money. If nobody's buying bonds, then they are likely buying stocks. And in that video, I went over what happened the last 4 times the yield curve inverted and how long it took for the bull market to peak after that, and what the return was. So 2019, the yield curve inverted. By the time there was a 2020 crash, 18% returns, almost 6 months until the bull market peaked. Before that, 21 months, 22 months, 19 months, and you can see an average 24% return, 39% return, 33% return in the S&P 500 between the time that the 10-year, 2-year flashed the inverted signal and the time that the bull market top was reached. So the market almost always creates a top first, which is why the 10-year, 2-year panic is overdone. However, the 10-year, 3-month, same idea. When the 3-month treasury rate is higher than the 10-year treasury rate, this usually signals that we are closer to that point of a recession, and we are actually getting further away. The spread is widening, means it is opposite of bad, right? So if this starts dropping towards 0, then you will know that we are likely headed towards a near recession scenario. However, unemployment is great. GDP is still very strong. What we're dealing with right now is massive price instability and rate hikes to try to deal with that. And speaking of rate hikes, there is now a 70% projected chance, 69.4 projected chance that there will be a 75 to 100 basis point Fed funds rate by May 4th. For those of you not keeping track of this story or are new to the markets, we are now at 0.25% or 25 basis points for the Fed funds rate because that is what the Fed raised it in March for the first time since the pandemic. And in terms of the actual markets and the charts, this is the SPY that tracks the S&P 500. This has been one of the top 15 worst first quarter performances in S&P 500 history. So this is one of the top 15 worst performances in the first quarter. However, as at the time of this recording, the S&P 500 and the NASDAQ have been ripping for 3 straight weeks. And if you've been following this channel, you know that all along we've been buying the dips at the major moving averages. We obviously bought the indexes. We bought Walmart, which is now nearing all-time highs once again. This is absolutely ripped for us. Google had a 12% gain after bouncing off the 300-day moving average. Amazon with almost a 20% gain after bouncing off of major support. Tesla ripping back into all-time high territories again. I mean, it was just an amazing 3 weeks, and also a testament to why you should not pay attention to trying to time the market if you are long-term investing. What you should pay attention to is the companies that you want to buy and the indexes that you want to buy and compare those prices with what you think those should be valued at. Apple was down 18%. This is a stock that everybody cries about that they wish they got cheaper. It tanks 18% and then people are afraid to buy because they say, oh, what if I buy here and it goes down more? But they are so happy to buy after it rips back up 20%. We send out all of our stock alerts on the Discord. Obviously, we have the options trades as well. We have the options day trades as well, where we wake up neutral and play either side depending on what goes on intraday. We smacked this Alibaba 115 put on Friday for 258% gain. There's a lovely beginner section where you can ask all the questions that you want. We help beginners with technical analysis, fundamental analysis, investing questions, etc. So come be a part of a lovely community of thousands of traders bouncing back ideas and questions all day, every day. And here are the top 4 stocks that I'm looking at to buy for April 2022. Obviously, as I mentioned, there's so much that has ripped up in the last 3 weeks since the last time I did a March 2022 top stocks to buy for March 2022. And there really isn't a lot of value. You can't just continue to buy stuff at all-time highs. Like Walmart, I would not buy here if I did not catch it on the dip. Same thing with Apple. You definitely don't want to buy Apple here if you didn't catch it on the dip. Tesla, same thing, reaching into all-time high territories. It doesn't mean these companies are bad. It just means you missed the boat. So quality stocks right now that I think have decent value. Let us take a look at the semiconductor ETF. Now, semiconductors have been absolutely shellacked by the supply shock that we've been experiencing in most products, but semiconductors are literally the backbone of so many products in the modern world, whether we're talking about tablets and phones, computers, cars, appliances, etc., you name it. So the lack of supply is really suppressing the output that these companies are able to execute. There's also a slowing demand after the pandemic in PCs and computers, because those things actually hit all-time highs during the pandemic due to a lot of remote work situations. That is why we saw that downgrade on AMD last week. Now, if you want to buy single semiconductor stocks, that's fine. I mean, you have AMD, you have Micron. Intel, we had called out, it hit $53 and then started scaling back as it normally does. I will look to buy back Intel at around the 44 or 45 range because I think it will get there again. It always does. But if you don't want to think about individual semiconductor stocks to buy, there is a semiconductor ETF. Now, keep in mind, this is a leverage ETF that trades at 3 times the regular ETF. So the regular ETF is SOXX, but it is rather expensive at $464 a share. So unless you have partial shares or a large amount of capital, then SOXL is a decent alternative. Just keep in mind that it is a leveraged bullish ETF, and you want to read up on the nuances of trading leveraged ETFs. Now, as always with these videos, this is not just a blind buy and hope to make money. I'm looking at a certain level on SOXL. There's this level here at just below $30, around $27, $28, that it might get to, especially considering the downgrade on AMD. If you want to see what's in this ETF, the top holdings are NVIDIA, Broadcom, AMD, Intel, Qualcomm, Texas Instruments, Microchip Technology, Marvell, and then to a lesser extent, you have Micron, TSM, etc. So there is this head and shoulders here on the 1 day, and it looks like we could get to that $27, $28 mark again. You can also sell cash secured puts. That's a whole entire different strategy. If you know what you're doing, fine. If not, again, come join the group, and that is something that we typically do on a lot of blue chip stocks in order to own them at a cheaper price. Stock number 2 that I'm looking at, another ETF. And for those of you that are wondering why there are so many ETFs here, is because ETFs are actually great ways to long-term invest, especially if you're not trying to pick individual stocks. So XLV is the healthcare ETF of the S&P 500. XLP is the consumer staples ETF of the S&P 500. XLE is energy. SPY-V is the value ETF. So we've actually invested a lot in these ETFs that are full of blue chip quality stocks. The second one is IWF. Now, IWF is an ETF that is based on the Russell 1000 Growth Index. If you are concerned with the NASDAQ being too tech heavy, take a look at what's in the Russell 1000. Yes, we have tech stocks as well, like Apple, Microsoft, Amazon, Tesla, Google, NVIDIA, Facebook. They dominate the top, but then you have Visa, Home Depot, MasterCard, AbbVie, Costco, Adobe, Eli Lilly, Pepsi, Coca-Cola, Nike, Netflix, UPS, PayPal. So it's a really great mix of blue chip quality growth stocks and the expense ratio is very cheap. This is basically, think of this like an APR that you have to pay in order to buy this managed fund, because the fund, how do they make money? They're managing this fund, so they have to charge a fee. 0.19% is very low in terms of an expense ratio. So I really like the IWF ETF, which is put out by iShares, one of the biggest ETF management companies. For IWF, you can start dollar cost averaging here. I wouldn't dump all of my funds at this price point on most things, but I don't mind dollar cost averaging here and then picking the next level down, which there is clear support at around 244, to put in another buy. At least that is for me. Obviously, do what is good for you. But this is an ETF that I don't mind. This is a blue chip ETF that I don't mind adding to my long-term portfolio, especially if I need exposure to more than just tech. Next stock I'm looking at is Nike. Nike continues to kill earnings, just blow it out of the water, and raise guidance as well. They did have a nice bounce from about the 117 mark to about 140 after earnings. Nike also pays out a nice quarterly dividend of 30 cents. And by the way, the last three stocks, the top three stocks so far that I talked about, all pay dividends as well. So that helps in a high inflationary environment, although the dividend is not enough alone to overtake inflation. Just keep that in mind. Nike very nicely filled this gap here, two gaps really, this gap and this gap here back from September 2020. And it currently maintains buy ratings from Goldman, JP Morgan, Wells Fargo, Guggenheim, Citigroup, Jefferies, Credit Suisse, BMO Capital, UBS, Morgan Stanley, you name it. I was definitely okay buying Nike here, especially after it popped out of the descending channel, because based on analysts' expectations or based on the analysis, is that Nike right now is reeling from what is going on geopolitically as well as the slowdown from China. But if you expect those things to be temporary, then Nike is actually undervalued here. Keep in mind, this is a long-term hold. I don't expect Nike to pop up right away. And lastly, I'm looking at the bank stocks, mainly Wells Fargo and Bank of America, although you guys know that I've been a fan of XLF, and we have been buying XLF on the dips, which is the financial sector ETF of the S&P 500. But if you don't want to jump into yet another ETF, I'm looking at Wells Fargo and Bank of America specifically because they are the two biggest banks, along with JP Morgan, when it comes to outstanding loans and when it comes to loans being a big part of their business model. So the reason is, with rates rising, banks will make more money if they can charge more. But right now, I want to take advantage of this weakness because of the yield curve inversion. Yield curve inversions tend to hurt banks in the short term because banks usually borrow at short-term rates and lend at longer-term ones. And if the 2-year is actually higher than the 10-year, that means that the banks are paying more to borrow short-term and can lend out for less amount of money than they can to borrow that money, right? But that is a very temporary scenario, a very temporary phenomenon. And when the yield curve finally gets back in order and the Fed continues to raise rates and the 10-year rates start going back up again, then that will positively affect the bank's revenues. This run-up that you see here in February, this was due to the fact that the Fed finally said they were going to raise rates. So it basically, Wells Fargo was at $60 after the 10-year started rising again due to the Fed's announcement that it was going to raise rates before the yield curve inversion threat. And Bank of America, same thing. Bank of America almost has a identical chart, rose up to $50. So I think there's a lot of upside long-term for banks, especially considering where we are with the Fed funds rate and what is to come in the next 1 to 5 years. Anyway, traders, that is it for this video. Hopefully you got something out of this video. Hopefully you got more than just, hey, look at this ticker symbol where you could just blindly buy it. No, hopefully you understand the markets more and more each and every day. That is what this channel provides. That is what I aim to provide, is a basic understanding of how the markets work, why certain stocks look attractive at different times, what actually affects stock prices and earnings and valuations, etc., and try to piece it all together. At the end of the day, this is complicated stuff, and I appreciate you being here with me. Again, I will have more of an announcement about the podcast that I'm going to appear on. There's actually 2 that I'm going to appear on, but I will have more announcements later. Sign up if you want access to all of our trade alerts, the day trades, the watch list, the long-term alerts, etc., the analysis on a daily basis. Sign up if you want access to that. Would love to have you. Leave a comment down below. Let me know what stocks you are trading for April 2022. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.